Good morning, everyone. Welcome to this rundown for global stocks and commodities for the 30th of April. Well, it's the start of May tomorrow, and so the sell-in May go away crowd are dusting off their agenda, and they're starting to come out in full force. And there's any amount of commentary that will tell you that the market's going to go into a decline, or it's going to crash, or it's going to do something that's fairly negative. So I just want to provide a perspective that I think is valuable because it's based on fact. It's not based on old wives' tales or what people think should happen because a certain amount of time has gone past. It's really just looking at things as they stand, looking at the economic facts, looking at the earnings facts, and most importantly of all, looking at the charts themselves because there are telltale signs, as I talk about every week, that can be gleaned from the market if your mind is open to what those chart patterns are telling you. So let's have a look at what happened last week. But first of all, just a bit of a bigger picture perspective. Commentators have been calling for a market top since the lows of 2009. So we're getting up towards 8 years now. And eventually they will be right. There will be a time where this current bull market that's now 8 years in the running, the market will top out, but who knows when that might be. This could run on for years to come yet. And how much of those negative commentators that are always looking for the top, always looking for a reason not to invest in the market as opposed to a reason to invest in the market, how much have they missed out on? The S&P index has risen from just under 700 points and it's now getting close to 2,400 points. That's more than tripled in terms of the S&P index value during that time. It's useful just to reflect on what a major market top does look like. And you've generally got to have a couple of things. You've got to have a level of euphoric sentiment where people start to believe that the only way for the market is up, that there is some sort of new paradigm and the market is just going to keep continuing. And that's when the surge of money comes in, which leads to a market top, because a market top forms when there is no new money left to come into the market to continue to support it at what are probably unrealistically high levels. And so the smart money starts to sell, recognizing this dynamic, and that is what creates a market top. We've not had that euphoric sentiment. It's been just so negative. This has been such a hated bull market since it started, and we still don't have those sentiment conditions. And as a consequence of that sentiment and that feeling that the market just has to continue going up, what happens is that prices tend to go exponential at the end. And one of the classic patterns, of course, was the NASDAQ in 2000, where the price just went absolutely ballistic at the end before it got ahead of itself and just fell under its own weight. So we haven't seen that happen yet either. We'll look at the charts. And the fact is, I don't believe we're even close to either of those things because they take time. People don't suddenly wake up one morning and become euphoric on the stock market. They don't read a report that suggests to them that they should suddenly abandon all caution and throw all their money at the stock market. That takes time. It takes the market continuing to work its way higher to dispel the negative sentiment. And so that's why I don't believe we are close to a major market top. Now, could we get a bit of weakness in the next few months? Yes, we could, but is that a market top? Absolutely not. So these are the facts as I see them. The market internals remain really strong. So that's the big picture backdrop, and that's what's important because markets do tend to fall apart at the smaller end first, and the smaller end of the market remains quite strong, as we'll see. Global economic growth is improving slowly. It's not setting any records, but it is improving. And the International Monetary Fund has just raised its forecast for 2017 to 3.5%. And that's a pretty useful rate of economic growth. So not that the IMF is necessarily an organisation that always gets it right, but the trend is certainly up. US economic growth in the first quarter is spluttering a little bit, but it's not a major problem. There are some parts of the economy that are doing well. Housing is certainly showing improving trends, and that's a really big part of the American market. Some other sectors are spluttering a little bit, but overall it's not too bad. But people that are talking about a recession is just it's just completely fanciful. And I'd ask you to consider, what if Trump can get some of his tax and spending agenda through? I find it hard to believe. There are so many advantages to the American economy, to the American consumer, that I find it difficult to see how all sides of politics can continue to stand in his way, because surely their constituents are going to be saying to them, why aren't you passing these laws that are going to be of significant benefit to me? So I believe that Trump will get some part of his tax and spending agenda together, and that'll have a significant boost to the American economy. And I don't think many people realize just how substantial that boost will be. It certainly goes way beyond the headlines that the media are running with, which is really just about corporate tax cuts. The tax plan is way, way bigger than that. And a couple of weeks ago, I touched on some of those issues. Now, the current US earnings season is the best in 10 years, and the forward guidance is quite robust. So it's not like this is the top and things get worse from here. The forward guidance is solid. Earnings growth for the S&P, and about half of the S&P companies have reported so far. Earnings growth is up 11.2% year on year, and that's a really good rate of increase. And ultimately, what is it that drives stock values at a big picture level in the end? It's earnings. Yeah, you get geopolitical situations, and yes, you get markets that get ahead of themselves and become excessively valued. But ultimately, the long-term trend of the market is driven by earnings, and earnings are strong, and the outward guidance is strong. So why can't stocks continue to increase? Now, the average PE ratio is 17 compared to the long term of 15.5, so it's a little bit higher, but you've got to remember that we're at record low interest rates, and it's always about money going where it's treated best. Turning now to American stocks, the S&P put on 25 points and is back very close to its all-time highs. And I believe if you look at the pattern of what we've been seeing over the last year or so, the current consolidation should complete soon if that pattern is to continue. The market is ranging between 2320 and 2400 for the last 10 weeks, and these consolidations don't tend to go on for too much longer than that. The Nasdaq and the Russell 2000 set new all-time highs, so that backs up the point I'm making about the market breadth being very strong. When the Russell 2000 is setting new all-time highs, that the small caps are joining in. Now, some commentators are pointing to the fact that the market's being led higher by Google and Amazon and Facebook and Netflix and all those stocks that are at outrageous PE multiples. And yes, they are at high PE multiples, and I can't really bring myself to buy those stocks, but I can certainly engage in a lot of other stocks that where their growth rates well and truly support their earnings. But the fact is that this is a multi-decade trend where the market is being created, or what am I trying to say? The big companies are swallowing up the smaller companies, and so naturally we've got a long-term trend where the biggest companies are forming a higher and higher percentage of the overall of the market. So it's only natural that they're going to lead the market higher. And I think that's just it's a dynamic of globalization. It's a dynamic of Western society, and it's hard to see what's going to break that cycle, to be honest. Small caps are still rising. That's the key point. So let's take a look at the American market. Just get to the right chart here. So this is the S&P index, and let's pan back and take a bigger picture look first of all. So the immediate things that I would ask you to look at in the time frame that we're looking at. So this is going back to the last sort of decent wobbly that the market had, which was in January, February of last year. So you can see now the red 200-day moving average line is moving up very strongly. Prices are well above that. They're above the blue 50 line. They've just gone back above them after a brief dip, and they're in fact above the 20-day moving average line. So all of those, where the prices are, where the moving averages are in relation to each other, they're all fanning out. That is a sign of strength. Now, one could argue that maybe they're getting a bit ahead of themselves, but what we're getting through this period is, again, so we're getting a rise, then we're getting a consolidation. Let me just mark the consolidation here. So here's our consolidation, and then we're getting another rise, and then another consolidation. This one was a bit shorter and a bit tighter. Then we get another rise, and now we've got another consolidation in this zone here. So you can see, if you look at the length of the consolidations, we're starting to get towards what we've seen over the last 12 months. So there is nothing whatsoever in that chart. All I see in that chart is strength, and I do not see a parabolic escalation of prices. So from my perspective, as I've said many times before, we stay with what is until it no longer is the case. And there is nothing in that chart at all other than strength, consolidation, and ongoing strength. Let's just check in on the NASDAQ. So NASDAQ at all-time highs. Yes, it is getting a bit ahead of where it gets above the 50-day moving average and probably above the 200. So we may see a bit of consolidation or even a little bit of a retrace in the top end of the NASDAQ, but that doesn't necessarily mean that all stocks within that index are going to fall. We are overbought on the RSI, so I think this is definitely a time where just a little bit of caution is required, but only in the sense of you want to buy dips. You don't want to be jumping into the stocks that have just been running up strongly and have set new highs. So focus on the sectors of strength, but buy the dips. And let's look at the Russell 2000. So new all-time highs there in the Russell, as you can see. A little bit of a turn down on Friday, but we've certainly still got a lot of strength in this small cap end of the market. It is still in a consolidation zone, although we did get a little bit of a temporary breakout for a couple of days towards the end of the week. But the Russell 2000 still looking good. Now, of course, currencies have a major impact on all other asset classes. This is the US dollar. So if we take a look back on the US dollar, you can see that we formed a range after rising from some lows. We formed a range between 92.5 and roughly 100. We managed to break above that, and now I've just gone into a consolidation, as you can see. So we've formed a nice triangle here. The US dollar is just showing signs of dropping out the bottom of that triangle, but of course that can always happen for a short period of time, a few days or a few weeks. So I can't pick which way this is going to go. Frankly, it could break either way from here, so I'm not paying too much attention to it. But of course, the direction of the US dollar will have an impact on commodities. Now, turning to the Australian dollar while I'm here. So there's the Aussie dollar. We've set up this range here. So big picture where we had a long downtrend from above parity. We've now gone into this range that has a low of just 68.5 and a high of around 78.5. We're certainly in the top part of that range. But if we zero into the shorter term, then we've got a range between 74.5 and 78, and we're right at the bottom of that range at the moment. So the US dollar, of course, is and commodity prices are what is impacting most on the Australian market. Looking now at the Australian index, we've moved back above 5,900. We had a reasonably healthy week thanks to the banks. But as I've been noting all along, the banks have come out of the 5 years of really good times, the tailwinds. The tailwinds have become headwinds, and therefore it's really difficult for me to see this index going too much higher from here. So the Aussie dollar finished just under 75, and the ASX put on 70 for the week. There are no new highs really in anything. There's just a tiny proportion of stocks that are setting new highs, and they tend to be stocks with a global exposure, not an Australian exposure, and they tend to be stocks that are more technology related, but there's not that many of them. Turning now to precious metals, gold was down by $17 to $12.69. That was largely because stocks went really a bit risk on after tensions settled down a little bit in North Korea, and it would appear that the centre party is going to win in France when the second round of the elections occur next week, and that is quite positive for markets. Now, interestingly, GLD, despite the fall in gold, GLD holdings, which is the world's largest ETF, went up again. So they've been steadily climbing from under 800 tonnes to about 850 tonnes or a bit more during this year. So that's a positive. So money's still going into ETFs. During the week, there was a small addition to both longs and shorts in the gold futures, but not a big change. But there was significant unwinding in the silver futures, and that was always going to have to happen because we were basically positioned at pretty much record highs. So that was a given. Now, there's been a self-reinforcing spiral downwards in GDXJ, which is due to the dynamics of basically that market or that index becoming too big for its universe of stocks, and it was threatening to own a too high a percentage of individual stocks, and which would then contravene various rules. So there's been some selling and some readjustment in that index. This creates both winners and losers in the short term, and also creates a bit of a self-reinforcing spiral, which is still playing out. Now, I don't know how much longer that's going to take to play out, and how much further down GDXJ may go, if at all. That's completely unclear. However, what is also very clear to me is that this longer term dynamic, which is currently creating a self-reinforcing spiral to the downside, will become a powerful tailwind to the upside. And if you really understand the dynamics of how exchange traded funds work, and how the competitive landscape in that industry works, you can really see this becoming a spiral that goes in the upwards direction and feeds on itself for a lengthy period of time. So I'm cautious, a bit certainly a bit wary in the short term of what's happening in the precious metals market. I still maintain the view that I think you should have some precious metals exposure because it can turn around very quickly, and you've just got to put up with a little bit of pain in the short term, because the long term for the sector, I believe, is really, really positive. So let's just take a look at that sector. So we'll start first of all with silver. You can see sharp move down in silver. We're now oversold. I think probably most of the selling has been done. I'd be surprised if there was too much more there. There's gold on a weekly basis. There's gold on a daily basis. And you can see we certainly steadied in the last 2 or 3 days of the week in gold, whereas silver continued to sell off. If we look at GDX, we can see we're really just in a band, in a consolidation band. We're back now back down to 22. We had got up around the 25 mark. So it's not a big fall, but it's really just a continued consolidation. If we look at GDXJ, a little bit weaker. We've actually formed a new shorter term low, but it is oversold. So I think the worst of it is quite possibly done. Turning now to other commodities, copper edged forward a bit, 259. That's largely currency. Crude oil was down a bit, down to 49. That was due to rising inventories of crude oil and petroleum products. And I continue to stress that if you are going to go into this sector, which I think is worthwhile for the longer term, but I'm not convinced we've seen the lows yet, then I think you need to protect yourself by really only focusing on the largest names. Certainly I wouldn't go into anything speculative in that sector yet. There's the spot copper chart. And just really wrapping it all up, given what's happening in Europe, given the improving economy in Europe, which is growing now more quickly than the US, given the relative valuations, European stocks and indeed Chinese stocks are significantly cheaper than America. Not that I think America is overvalued, because I don't, but I just think there is better value in Europe. The issues over there with Brexit and the French elections don't seem to be worrying markets to any extent at the moment. So, perhaps one way to do that is via some ETFs listed in America, which are European facing. So there could be a case there. My advice would be maintain a focus on the long term and on the sectors that are largely immune from the things that tend to disrupt trends. That's geopolitics and governments and central banks. They interrupt trends in the shorter term. They don't change them, but they certainly can interrupt them. Don't be thrown off by shorter term weakness. Have the courage of your convictions and the research that you've done, if you're doing any, and stick to your game plan. That's it for this week. I'm sure there'll be lots of interesting things happening in the week, and I'll speak with you again next weekend. Cheers.